Mastering Your Mortgage, a Debt Consolidation webinar. Hi, it's RASHA INGRATTA'S, licensed mortgage agent with Mortgage Intelligence here in Windsor, Ontario. Today, in this webinar, we will be covering using your home equity to consolidate debt, considerations to make when consolidating debt, real-life examples, mortgage renewal strategy, managing finances post-debt consolidation, using your home equity to consolidate debt. Debt consolidation is the process of consolidating your high-interest credit card debt, car loans, or other personal loans into your mortgage. The goal with debt consolidation is to streamline your financials into one monthly mortgage payment, lowering your overall interest rate and increasing your monthly cash flow. Considerations to make when consolidating debt. There are a couple of things you should consider when deciding whether or not it's a good time to consolidate your debts. Number one, your financial situation. If you've accumulated a large amount of debt over the years and are not sure if you're able to pay it off, consolidating your debt into your mortgage may be an option. Number two, current rate environment. You'll also want to consider the current rate environment when consolidating your debt. You'll be refinancing your mortgage, meaning you'll be subject to current market rates. This is why it's important to have a discussion with your mortgage agent before proceeding to see if it financially makes sense. Another route to explore if you have a favorable mortgage rate you don't want to break would be adding a second mortgage to the house or a home equity line of credit, a HELOC. It is also important when you're doing a second mortgage is to line it up to come up for renewal at the same time your first mortgage is coming up for renewal. Number three, your mortgage renewal date. The third thing to consider when deciding whether or not to consolidate your debt would be when is your mortgage coming up for renewal. This is important because if you consolidate your debt at renewal, you are not breaking your mortgage contract, meaning you won't be charged a penalty. This is another great time to do a full review of your financials to see if making some changes to your mortgage could help with your financial goals. Real life consolidation examples here. Your financial situation before your debt consolidation can look like this. So your current mortgage is at $150,000. Your current interest rate is at 3%. Your remaining amortization is 10 years. Your home value is $600,000. Your mortgage payment is $1,447 a month. Unsecured debt total, and that includes credit cards, lines of credit, and such, $50,000. Your payment on that debt, $1,500 a month. Total monthly debt obligation, $2,947. That's adding the $1,447 and the $1,500. Your financial situation after your debt consolidation. New mortgage balance, $200,000 with unsecured debts included, paying out the $50,000 and your mortgage of $150,000. Your new rate, let's say, is at 5.59%. Your new amortization, 15 years. Your new payment, $1,636 a month. Your total month debt obligation, $1,636 a month. A cash flow increase of $1,311 a month. Now, I put the calculation here below. $1,447 original mortgage, $1,500 unsecured debt. Your new mortgage payment, $1,636. So when you minus that from the original monthly payment that you had, it brings us to a $1,311 monthly cash flow. Now, of course, in this example, we stretched the amortization from 10 to 15 years, which brings us to the next example. Keep your amortization the same while consolidating your debt. So your new mortgage is $200,000, your interest rate is 5.59, your current amortization is 10 years, so we are keeping it at 10 years. Your new payment is $2,173. So now you still have a cash flow increase of $774 a month. If you kept the payments the same as if you were still paying $1,500 on the credit cards, your amortization would decrease to 7 years. So your mortgage balance, $200,000, rate 5.59, your new payment is $2,876. It is still lesser than the $29.47 payment your original payment, your mortgage payment, and your $1,500 home equity, the $50,000 debt, unsecured debt, $2,947. If you did a $2,876 monthly payment, as if you were still paying that $1,500 towards your debt, it would reduce your amortization from 10 years to 7 years. Strategies for mortgage renewal. So let's take a quick look at a strategy that you can implement when coming up for renewal to help with your cash flow. 5 years ago, in 2019, you got a mortgage for $300,000 with an interest rate of 3.29% with a 25-year amortization. Your monthly payment being $1,465. 5 years later, you owe $257,000 with 20 years amortization remaining at a new market rate at 5.59%. Your new payment would be $1,771. That's an increase of $307 based on the new interest rate and your amortization being at 20 years. If you are tight on cash flow and can't fit that $307 increase into your budget, you could increase your amortization back up to 25 years. So if your payment with the 25-year amortization, mortgage balance of $257 and rate of $559, you'd be looking at a payment of $1,582. So instead of an increased payment of $307, it's only now $118. 5 years down the road, your new mortgage balance would be $229. And let's say interest rates lowered to 4%. You can bring your amortization down to 15 years, which would put it back on track to its original amortization. Your new payment would be $1,690. Managing your finances post-debt consolidation is a great first step towards structuring your finances. Consolidating and planning your financial landscape is key in establishing a healthy budget, allowing you to keep your finances in check and your debt levels low. If you have any questions and want a review of your mortgage and debt situation, call my office at 519-250-4848 or email me at rasha@shopmortgages.ca. Myself or one of my team members will be happy to assist. Again, it's RASHA INGRATTA, Mortgage Intelligence, and thank you for listening.